Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveney. And today I wanted to share with people what we're seeing in the marketplace in regards to loans, types of loans, but not really on the buying side, but on the managing side. And what are the outcomes and scenarios that we're starting to see as I believe we continue on with where the economy is headed. And I can share my opinions of that. But I'm a true believer that I think people have a lot of equity in their home. People are going to fight tooth and nail to stay in these properties, and we're going to continue to see less and less foreclosures, and note investors are going to have to be a little more creative in trying to work out win-win scenarios. So today I want to highlight kind of two case studies that really illustrate some of the things we're seeing, and probably in near future I want to record one about the bankruptcies, because absolutely seeing a lot of bankruptcies starting to fall into play, which makes sense because I was recently reading a report from the New York Fed that credit card and just debt in general and delinquencies are skyrocketing. Mortgages are still pretty low, but credit card and car are starting to take off at a higher rate than it was in 2008. So I was in an argument this weekend. I don't want to call it argument, but I was debating somebody this weekend on a forum post about they are overpaying for properties. And that is a whole model to overpay by $25,000 to get the seller to finance it at a lower rate. And they are just saying, well, the economy, the housing is going to appreciate by 5% per year. So I'm going to be fine. And I'm going to put renters in these and nothing to worry about. And the person has no liquidity, no reserves. And when I mentioned, well, when you realize you mentioned like prices appreciate, it's more on historically about 3%, that it's not linear. It goes up, goes down. And unfortunately, it's typically when it goes down is when people are having the most trouble and then renters stop paying. Now, if you have the liquidity to weather that storm, you're fine. But look at what happened in 2008. People had 100% financing. This person's got 120% financing or 110% financing in most cases. I actually pinned a little comment, see where this person is in like 2 years, because probably not going to be a good spot, unfortunately. But let's talk about some of what we're seeing, some of the case studies that we're going through, and talk some loans. So first one I want to talk about is a loan that we had in Iowa. And this was a loan that we purchased around 60 cents on the dollar. The borrower was about 10 months behind, and it was a pool we bought with 15 plus other assets about a year ago. And our standard MO is, servicer gets it boarded, we send a demand. Now, why do we send a demand? If you haven't listened to our prior webinars, I can explain it briefly. But we send a demand because people typically will get engaged or re-engage with a lender once a demand letter is sent. In this instance, he didn't re-engage. And come to find out, in October, the borrower passed away. And we had started with the foreclosure process and, continued down that path until we heard from one of the heirs. And it was reach out to the servicer, who they gave our information, and they provided the servicer with a copy of the death certificate and confirmation that, yes, they are responsible for this asset. And the woman was from out of state and said to me, essentially, hey, look, we're going to sell the property. It was my father's property. We're all out of state. And can you, the lender, the servicer said this much is owed. We're going to sell the property for $225,000 roughly is what the agent's telling us. So there's a lot of equity. Can you work with us in regards to, if it goes at sale, probably sell for less. So is there anything you can work with us on in that fashion? And when people say, what does that mean to work with? Well, there's several things you can do. One is, you can delay the foreclosure or push a foreclosure, which happens in many instances. And in this case, the foreclosure wasn't set until right around this time, which is in May of 2024. And this is all going on, by the way, in November, kind of December timeframe. And said, hey, look, nothing's going to happen until May. As goodwill, what would be great is, to see the property on the market for sale, to see it's cleaned out and in a condition, because we've seen some people who put properties out there for sale and literally it's atrocious in regards to, we have one right now where they didn't even make their bed. There's trash on the floor and the agent still took pictures, which, blows my mind. But let it be. So they, got the house trashed out. They got it cleaned out. And actually they had been speaking to somebody in the neighborhood who was interested in buying the house. They put on the market, told us what it was listed for. We usually ask if the agent is related in any way, shape, or form, because sometimes people will have somebody they know list the agent and then never appear to a showing just to stall. We didn't anticipate this in this case because there's nobody living in the property, but properties where the borrower is still living in, they may list it on the market, but they have no intention of selling. They just make it look like they're listing it. So we were working with this borrower, or the heir, and, just stayed in communication, and they let us know, and let the servicer know in late January that, they had an offer, they were accepting it, and it was going to close in late February. And she reached back out and just said, hey, I just want to confirm, here's the title, here's a closing. I know sometimes you have additional costs that get incurred, to continue with the foreclosure process. Is there any way you can kind of freeze from adding any charges to the loan, from that standpoint? And we said, hey, look, would you be willing to share with us the offer? Was it cash? Was it financing? Was it? And, she basically sent us, information on the offer, which was very strong, good earnest money deposit. So we said, yes, we can, for 30 days. And when we spoke to the attorney, there was very minor work that would have been needed that it's not going to really slow you up. So we worked with them on that. And, they ended up closing in February and we got that loan paid off. So in this instance, I know some lenders would be the type that would ignore the emails, not pick up the phone call, and just continue to plow through with foreclosures. For us, when I was younger and starting in this space, sometimes you felt like you have to win every battle. And to me, this was a win-win. But sometimes, you got to do we do what's best for, our team, our investors, and we try and work with people in the same token. And if we can create that win-win, which we did in this case. Now, they got to sell the house at top dollar. We got paid off. We got paid off in a faster time frame. And we didn't have to go put more money out of our pocket in legal to expend on the process. So it's a unique situation. I just want to share it with people, kind of to understand. Most people think note investing is black and white. It really isn't. So next case study I want to mention, this one was in Arizona. And again, this boils down to several things. One is trying to work with a borrower, speaking to your attorneys, but understanding the options. And I'll explain that when we go through this case study. But if you know all the options available, sometimes that just creates opportunity. And here's another example of, this was a house that was worth over $500,000. There's under a $50,000 balance on this loan. We picked it up at about 65 cents on the dollar. It was non-performing, and the borrower was, around 12 months behind. We acquired it again about a year ago, and the borrower would stop paying about a year prior. Again, follow our SOPs, standard operating procedures, send the demand, no response. So foreclosure was set in December, which Arizona, is a pretty quick state. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. Once the foreclosure finally got set, here comes the borrower. The borrower reached out to the servicer and, of course, wanted to keep the house. Who wouldn't want to keep a $500,000 home that has a balance of less than $50,000? But the borrower also was about $8,000 behind and, was trying to work something out. So we recommend the servicer put them in contact with the housing assistance program within the state to see if the borrower would qualify. Lo and behold, borrower qualified for housing assistance. So this process, does take time. And again, it goes back to like that other case study of, do you wait? Do you foreclose? Like, what do you do? Now, you have to understand in these situations, the chances of that borrower letting you go to foreclosure are pretty much zero. No borrower in their right mind is going to let a home go to foreclosure sale that has close to $500,000 in equity, especially only being behind $8,000. So we did not push the date. We did tell the borrower, hey, you have till December. So let's push, because you still have to give them some deadline. You still have to let them understand that it's just not at their pace. You realize that borrowers, when they're put up against a deadline, they typically will react much faster. So this borrower was able to get $8,000 in assistance, which came right to us. So we got $8,000, brought the loan current, and then the borrower was still able to make those monthly payments after that. And the reason why is they had several job losses that just caught up. But they're back on track and they're able to make their payments. So we got the $8,000. Then we continued to receive some payments. Then we turned around, we sold the loan as a reperforming loan on the market. And we sold it for a few $1,000s more than what we paid for it. But you take into account the around $10,000 we got in payments as well. We made a nice profit of between $10,000 and $15,000 on a loan within a year. I share this story because, again, sometimes people who just push and have tunnel vision thinking, okay, we'll go to foreclosure. This borrower files bankruptcy. That $8,000 is going to be spread out over 60 months. So you're getting $120 to $140 a month during the bankruptcy extra instead of getting it all up front just because you push too hard. So, you got to know put on the pedal, when to take it off. And again, with people having significant equity, we're seeing a lot more bankruptcies. Within our portfolio in 2023, now we did have 6 foreclosures out of 150 plus assets, which several were from deceased borrowers, within that we had to take to foreclosure, or they didn't want the property. I don't think any of them were borrowers that actually wanted the property and just decided, I'm not going to file bankruptcy. We continue to see an uptick in bankruptcies. Last month, I believe we saw 3 within our portfolio. And this month right now, based on where things are looking, within the next 30 to 45 days, we anticipate we'll probably see another 2 or 3 bankruptcies. Now, someone may ask us the question, okay, like people are going into the bankruptcy, and a lot of people will think bankruptcy is a bad thing. Bankruptcy is a restructuring. And sometimes that's what borrowers need, because a borrower who hasn't paid in 4 years their mortgage or any of their other debts, or they're behind those debts on a year or 2 years, them coming to the table thinking, okay, I have no money down, but I'm going to, pay this, pay that. What they end up doing is they typically will just pay whoever's screaming the loudest that month and let the other ones fall. Sometimes they restructure in the bankruptcy, that restructures everything, is what's best for them to allow them to stay in their home. Now there's the, probably the embarrassment factor of you had to file bankruptcy, but in the long run, in 5 years, if you're all caught up, your debts are all clean, that's probably a benefit for this person, because some people are just swimming and sinking in so much debt. So I wanted to share those 2 case studies for people for, kind of the things what we are and are not seeing. I'm going to spend the last few minutes, again, just talking about the market and where things are headed and what we're seeing. We continue to see a significant number of loans come across our desk, starting to see an uptick in the non-performing loans, as well as scratch and dent loans. The pricing of loans is pretty much stabilized, and people, again, will think, oh my God, loan prices are too expensive. It's too much. Guess what, people? Everything is expensive today. Now, you can still make good money. But 5-6 years ago, you buy an asset at 30, 40 cents on the dollar, you were making, if you manage it properly, 50 to 100% returns on some of those assets. Today, you can still make double-digit returns on performing and non-performing starting in the 20s. It's still available with multiple exit strategies. But people, I think, are stuck in prior times, as well as I know there's some gurus out there that teach you don't pay more than 30 or 50 or 60 cents on the dollar for an asset, but you didn't even look at the numbers behind it. If you're in a state that's non-judicial and it's a 6-month timeline and the borrower is behind and they file bankruptcy and start paying, you get all those extra payments, which is a windfall. Or if something happened where you have to foreclose, you're in and out of that deal in 6 months. You can make $20,000 on that deal. Okay, maybe you make 17, maybe you make 23, but it would be very difficult for you to not make anything or lose significant amount, like you're seeing a lot of other syndications going on today. So some people sometimes just get so caught up in the whole IRR or their yield or what their return is. This is, my wife and I joke about this all the time. I tell my wife, oh, I made an 18% IRR. She'll look at me and she'll, great. How much money did you deposit in the account? She doesn't care what the IRR is. She wants to know how much money is going in the bank account. Because you can't spend IRR, but you can spend the money that's in your bank account. So hope everyone enjoyed this episode of Creating Wealth Simplified. For more information on our Regulation A+ offering, check us out at seveneyinvestments.com. If you are a note investor looking for assets, you can reach out to us at asset-sales@seveneyinvestments.com to sign our NDA and get on our list where we send out assets typically on a monthly basis. Thank you all for listening. Take care. Catch you on the next one. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.